In terms of rate hikes, it looks like the market is now pricing in as many as 5. What are you looking at?
Yeah, look, we think generally the market has done some of the bidding for the Fed. Keep in mind, we not only have yields that are much higher, we have, as you noted, markets now pricing in 5 rate hikes, a balance sheet reduction in July, and the Fed has yet to move. So certainly markets have done some of the work for the Fed. But keep in mind, we are still at the zero bound, even with inflation elevated and labor markets very tight. In our view, we think that the Fed will move quickly in the first months of its tightening cycle. So probably 25 basis point rate hikes for the next 3 quarters or so, starting in March. But at that point, we do think the Fed will maybe take a pause, assess the economic environment, see if in fact inflation has moderated to some extent, see what the impact is on things like credit spreads, GDP growth, and broader, economic backdrop. And I think that's really when the Fed will make the move, whether or not to keep accelerating or perhaps take a more gradual pace.
As we show a chart of what happens often with the S&P as you move into those tightening cycles. Mona, we've seen so much of the stock market carnage through the lens of technology stocks, but we started this hour by talking about perhaps less money in the pockets of Americans, the consumer side. When it comes to sectors that might be challenged, like retailers, for example, could they be stuck with too much inventory? What are you thinking about in terms of the industry trends that are going to play out over the next few months?
Yeah, absolutely. We think generally what this Fed tightening cycle will be doing and the removal of liquidity with its balance sheet actions will really have a valuation impact more so than a real economy impact. So from a valuation perspective, some of those more speculative parts of the market, certainly some of the more higher valuation parts of the market, we still think they might see bouts of volatility. Where we do think that investors may win relatively are areas that are levered to a potential rebound in the economy, especially as the Omicron variant starts to fade. We see value in cyclical parts of the market, including, parts of financials that do well in a rising rate environment, parts of the industrial market, which especially are levered to reopening. Think aerospace, think even parts of the infrastructure market that could do well in an infrastructure-focused economy. But also, we tend to think that international and non-U.S. markets can also play some catch-up here. So certainly value cyclical, EM and non-U.S. But in tech broadly, while we'd still avoid those larger, speculative, higher valuation parts of the market, we would look at things that are more robust, have proven business models, have positive cash flows. And some of the themes we're looking at there, enterprise spending this year, we think will pick up in both hardware and software. We certainly think mobile payments has some legs, especially as consumption, as you noted, both online and in person resumes. And then there's things like semiconductors, which may benefit if we do, in fact, get some of that supply chain easing. So those are some of the themes that we're thinking about, ways for investors to win relatively in a tough market this year.
Are commodities an important part of investors' portfolios right now, or have we seen all of this inflation, all of the supply chain issues, all of the geopolitical tensions already priced in?
Yeah, it's a fair point. We certainly don't see a repeat of some of the dramatic moves we saw in 2021. So WTI last year was up nearly 50 to 60%. We've already seen a strong move this year thus far, 15 to 20% in energy markets. We don't see that extending to the same extent it did last year. So we do think a lot of the gains have been front loaded. And especially if we start to see inflation moderate in the back half of the year, which we expect, we think that story could start to fade as well. But keep in mind, this first half of the year will be very levered to a cyclically driven economy and an inflation-driven economy. And so from that perspective, you could be looking at a first half, second half story in commodities as well.